everyone, I'm Rebecca Maclean. So I co-manage Dunedin Income Growth Investment Trust. And yeah, new branding, absolutely, name change. Aberdeen changed their name today to Aberdeen, but with the E's. So can I introduce you to the second oldest investment trust? So 152 years old. The trust looks to generate growth in capital and income through investing in mostly UK companies, UK equities, but also some European businesses. So today's presentation, I'm going to start with talking about why I think UK income is an attractive asset class. Then we'll talk about the investment strategy at Dunedin Income Growth. And then we'll talk about the outlook for the trust. So we're going to talk about, the UK market is known for income, but actually the income delivered by the UK market is not as safe as people think. And so we take a strategy which is to look at quality companies and businesses which can deliver resilient income. And we'll talk about why we think this is the right strategy. So some key highlights from the trust. So the dividend is crucial, so important. The board is focused on the dividend. There's a 42-year track record of maintaining and growing the dividend. One of the benefits of the investment trust structure is it allows flexibility to do that, so it's really important. Long-term total returns from the trust. This is from 2018, and the dividend yield on the share price now is at a premium to the market, so 4.9%, which is a premium to the market. It's also above other equity income trusts too. So we'll talk about why that is. And the shares are trading at a discount to NAV, so 11% discount. That's persisted this year. And given it's a portfolio of liquid companies, it's sort of a question as to why that's been the case, and we're looking to try and close that discount. So most very common question I get when I speak about the trust is, why would you invest in UK equities when you can buy government bonds and get a risk-free fixed income? So I thought I'd start there as a topic. So I think there are 3 points to make. I think there are 2 positives for the asset class and 1 negative. So the positives are, you would expect there to be growth in that dividend. So you're getting that income, as I say, the dividend yield on the trust is 4.9%. But you would expect the dividends to grow. And as I say, the trust has got a 42-year track record of maintaining and growing that dividend. So that's one thing. In terms of a total return, you're not going to get that growth in the fixed income for government bonds. The second is around inflation. So typically, companies which have got good pricing power are able to manage fluctuations in inflation and pass that on to their customers. And so in an element, you're getting an element of inflation hedge, which again, if you've got a fixed income mandate, then the inflation can eat away at that income. And then the third point is capital risk. So that's the risk you're taking when it comes to equities. Equities, they are a riskier asset class. The capital can appreciate. It can also go down. So I think that is the risk. If we look over the long term, though, the UK market has delivered a positive total return, and Dunedin Income Growth over the period to January 2016 has delivered nearly 8% total return. So that's the sort of the track record, but I suppose that's the risk associated with the asset class. But we think that potential to grow your dividend and the inflation hedge means that it's an attractive place to be. Now, there are risks. I mean, headline risk is something, it's not new, it's heightened. Every morning we're sort of waking up to see what's the headline that's going to move the markets, and we've seen some big volatility in the markets associated with those headlines. There are risks on the horizon. I think now it's more important than ever to be looking at how companies are able to manage what is an uncertain world and the changes in the macroeconomic environment. So some of the risks on the horizon, we're talking about inflation. It's been stickier than people had expected. What does that mean for interest rates? Growth has been good. I mean, it surprised positively globally, growth. But now we're starting to see some moderation, some questions around growth in the US, the health of the US consumer. So that's certainly a risk on the horizon. And I've got this chart on the right-hand side, which I'm sure many of you have seen before, which looks at the valuation of different equity markets. And so one point to make is you've got a big difference between the valuations of different markets. And in the US market in particular, which has been the focus, and very strong returns from the US market over the last 2 years, valuations are high and the concentration in those markets are high. So 40% of the US market is made up by 10 companies. I think it's really interesting thinking about the market cap of those 10 businesses versus the whole of the European market. That's about 160% now. So there's a high level of concentration in the US market, which is skewing some of those valuation metrics that you're seeing. So you can see the US, the blue bar is the sort of historic range, interquartile range, and you can see from the teal diamond where the current multiple is. Now this was January. The US market has come off a bit since then, but I mean, broadly, the point is valuations are high in the US, and we've highlighted the UK at the other end where it's trading towards the lower end of its historic range. There isn't much optimism in the UK market at the moment. And valuation matters. I mean, there isn't an asset which, it doesn't matter what the valuation is you pay. And the higher the multiple, the more risks there are associated with that equity investment if you were to see a derating or, sort of a change in that multiple. So this chart plots the cyclically adjusted PE. So what it does is it takes historic earnings for the market and it averages them. So that smooths out some volatility that you get through a cycle. And it compares the price to earnings multiple on that basis. And then it looks at the 5-year total return from that point of valuation. And what it's showing is that the starting valuation does matter for prospective returns. So you can see this historic plot. You can see the US market in the purple, given where the current cyclically adjusted multiple is. Historically, there have not been times that you've not generated a positive total return in the next 5 years from that starting point. Meanwhile, in Europe, the valuations are much lower, and historically, there have been good future returns generated at that level on that multiple. So it's to make the point that valuation historically does matter. You can't just buy an asset at any price if we're thinking about long-term investments and protecting your capital. I mean, the UK, it is unloved, it's out of favour. That's nothing new to you. This sort of chart on the left-hand side is showing the price to earnings multiple, which is the valuation of the UK market. The lower the multiple, it's showing that there's not much optimism in terms of the UK, lots of doom and gloom in terms of the stock market. Actually, when we speak to the companies, we've got some excellent businesses in the UK, really strong companies with strong customer relationships and products, and they're scratching their heads at their multiples and their valuations, and they're sort of saying, why is it that the UK is so cheap? So thinking about the UK market, the level of GDP growth in the UK is pretty low. We're expecting about 1% this year. The UK consumer is in a pretty good health in terms of the balance sheets and the cash flows of the consumer, but they're lacking confidence and businesses lacking confidence. And so that is creating some nervousness. But when we look across the opportunity set of UK companies, we're not hearing doom and gloom in terms of what they're seeing. But they are worried about they're concerned about their share price, and that then bears out on the right-hand side, which is the buybacks. So this is where companies are using their excess capital to buy back their shares, and we've seen the number of companies which are doing buybacks increase from about 10% in 2018 to 40%, which speaks to the companies, the health of the company's balance sheets and that excess cash they've got, but also their multiples as well, and what they're seeing in terms of their own valuation. So I think this is setting the scene to say expectations are low in the UK, valuations are low, and that should provide a good starting point for future returns, as the previous slide highlighted. So the second oldest investment trust, Dunedin Income Growth, investing in UK and European companies. The strategy in the portfolio is different from the benchmark, which is the FTSE All-Share. So the strategy is to focus on total return, and we'll talk about why that is. We're looking for companies that can generate income, but also can grow that income. We are active positioning, so there are 33 holdings in the trust. We're selecting our best ideas. The portfolio is very different from the benchmark. We're looking for companies with resilient income, so we need to have a high level of confidence that those companies can pay that dividend. Again, we'll come on to talk about actually that the UK market dividends aren't that safe. And finally, we've got a sustainability strategy, which we've had in place for a number of years now, which is all about working out what are those long-term themes which could impact companies and how companies are managing their risks. So back in 2016, this decision was taken to change the investment approach for Dunedin, which was, at that time, it was focusing more on high-yield businesses. And it moved towards looking for quality and growth companies. And why was that? I mean, this chart shows the long-term realized returns of different markets. And you can see it broken down into the dividend yield, the dividend growth, and then multiple expansion. And what you'd take from this chart would be that looking back in history, the UK market, most of the returns have come from the dividends which are paid. So companies are paying out dividends, then, which means that they're probably not investing in their own business, and as such, you're not getting much of a flywheel in terms of capital growth in the UK businesses. And that compares quite starkly to the US market, which has delivered a higher level of growth, and a lower proportion of that's come from dividends. So you may look at this chart and say, well, we should just be in the UK looking for high-yielding companies, and that's the way that we're going to make money. But we think that is not the right strategy, because you have to be careful about companies which have got a high yield. Many, high-yielding businesses, it looks like it's a high expected dividend yield, but the realized dividend is lower. So you get this gap. The higher sort of the yield, the less likely it is to get paid. And that's because those, and often those businesses are high yields for a reason. Maybe they're mature businesses, maybe they are not growing, and they're not generating enough cash in order to expand over time. So this is one thing we are cautious of high-yielding companies. If a company's got a high yield, we're really kicking the tires on the ability of that company to be able to pay that dividend. And we think this is the right strategy for a long-term perspective of investing for income. So this is this is the returns of the portfolio since January 2016, when that change was made from looking for high yield to looking at total return. And you can see the performance versus the benchmark and the share price too. Now we'll come on to talk about the share price, but the share price has lagged the underlying asset growth in the portfolio, and that discount has widened. So the UK is known for being a high-yielding market. People think about the UK when they think about income investing, but the point that I'd sort of make would be that the dividends aren't that safe. So 40% of the dividends in the FTSE All-Share are in mining, banks, and oil and gas. And these are cyclical industries. They are driven by macroeconomic factors which are outside of their control: oil price, commodity prices, interest rates, and this means that you can get fluctuations in that dividend. And indeed, if you look at those top 8 dividend payers in the FTSE All-Share, 5 out of those 8 have cut their dividend in the last 15 years. So, in COVID, the dividend payments from the UK market went down over 30%, and that's because of the weighting towards these cyclical businesses. So you'll see that the portfolio's top dividend payers are very different from the benchmarks. There's only one overlap, which is Unilever. And as I say, in general, we're looking for companies which have got resilient income. So we're really kicking the tires on these top dividend payers. We have to be very confident that they are able to pay that dividend. And where 5 out of the 8 cut their dividend in the last 15 years for the benchmark, only 2 have cut their dividend for the portfolio, which sort of speaks to that difference in resiliency of the ability of those companies to pay their dividend. So one of the benefits of the investment trust structure is that you are able to support the dividend payments of the trust. So this is the longer term track record of the trust's dividend payments. So 42 years of paying or maintaining that dividend. There was 1 year where they kept it, 2 years where they kept it flat in 2010 and 2011, but apart from that, it's been growth. And actually last year, the dividend was increased 5%. So, one of the benefits of investment trust is that you have the balance sheet and you're able to support some of the fluctuations that you get in the underlying dividend payments of the companies. The trust has got revenue reserves, which you can draw on to do that. And we also use option writing, and there's gearing as well, which generates additional income for the trust. So as I said, the portfolio is very different from the benchmark. It's a high conviction portfolio. We've got 33 holdings, and we are following that strategy because we think it places the portfolio in the best place for future long-term returns. We are overweight the UK mid-cap index, where we think there are some really interesting and innovative quality companies which have been sold off in the last couple of years, and actually valuations are very attractive. And the trust also can invest overseas, so it's got 21% of its assets in European companies. On the right-hand side, we're plotting the income investment trust sector. And every sort of white dot is a UK income investment trust. And on the bottom, you can see the style bias of the trust. So it goes all the way from sort of deep value to core to high growth. And then you can see the market cap spread also of the investment trust. And the pink dot is Dunedin income growth. And I think what you can see is it has got a different shape, the portfolio. So it is more towards growth, and it's got more mid-caps in the portfolio, which means it is different for having that quality growth bias, which means that it can be a good complement to other investment trusts because you're getting different exposures, and those investment trusts should perform differently through the cycle. But even though we're focusing on quality companies and resilient businesses, this is not at the expense of the dividend. So the dividend yield on the trust is nearly 5%, which is a 28% premium to the market. It's also a premium to the average of this sector. So you're getting a premium dividend, but you're also getting that differentiated exposure to quality companies. So I wanted to highlight a couple of names in the portfolio to give you a sense of the types of companies that we're looking for. GTT is a French-listed business. They design the membranes which go into storing LNG in big carriers. They've got a strong dominant position, so over 90% market share. They've got great visibility of their order book as we can see growth in the number of LNG carriers on the horizon, which means that we've got good visibility of the earnings and the cash generation of the business. And they do pay out 80% of their earnings in the dividend. So there's also an attractive dividend yield, and there's that, as I say, the visibility of earnings. An above market dividend yield of over 5.5%. The market's about is about 3.8%. And then for Softcat, this is an interesting UK mid-cap company, so a smaller business. They sell IT, software and hardware into mid-sized businesses in the UK and the public sector. They've been a phenomenal performer from an operational perspective, taking market share, and they're now the leader. Strong culture, they've got a strong reputation. This is a large market, and IT spend is much less discretionary for businesses now, so they're benefiting from that. So whilst it's a lower yielding company, actually, it should be able to deliver good growth given that runway. So I'm going to sort of finish up here. This is the last slide. So maybe just sort of start with the outlook. So I think the UK and Europe has really faced a number of challenges when we think about what's been driving markets. So you've got the risk of unpredictable tariffs in the US. You've got weaker Chinese economy, and it's sort of been covered. It's sort of caught in the middle of those two things. And meanwhile, there are questions about the UK economy and sort of the health of the economy. But actually, we think the UK economy is in a pretty good place, and the UK consumer, even though they lack confidence, they're in a healthy position. But we think because of all those risks which are on the horizon, it's more important than ever ever to be thinking about quality businesses, businesses which are able to grow through different economic cycles, which have got strong competitive positions, strong financials and balance sheets. And that's what we're focusing our ideas, our portfolio on. And then sort of meanwhile, we have this discount on the shares. So we talk about there being a triple discount. So we talked about the UK market is trading at the low end of its historic range. The premium of the portfolio over the market is lower than history. And the shares are trading at a discount to their NAV. So there's sort of three valuation arguments there to be made about the trust, which we think that sets it up well for prospective returns.
Thank you very much. Thank you. Super. As if you have a question, please raise your hand and wait for the microphone from Chris or Steve to come over. First question at the back here, please. Thank you.
I think I've heard the word dividend, was it 150 times you mentioned it? So, Unilever. Is first question. What do you think about the changes in Unilever? And the seventh largest holding is Diageo. And I'd be interested to know why you're still holding it, considering the issues in the future as far as drugs are concerned, and Nova Disc and Lilly, etc. Because I know some fund managers, Fundsmith being one of them, has got rid of it. So.
Yeah, sure. Yeah, Unilever. So the company, is in the middle of a turnaround. So the CEO, which is now the ex-CEO, been in place for about 18 months, had set out a strategy in order to focus the business on the top power brands. And we'd started to see that come through in terms of the results at the end of last year, where the organic growth, which has been lackluster, it's really been impacted by its exposure to emerging markets, which have been weaker in the last couple of years. We started to see that come through in terms of the organic growth. They made an announcement about the ice cream business, which they were going to separate out, which should also unlock some growth within the core business. However, we've had a change in CEO. So the last couple of weeks, we've heard that the CFO is going to be moving up to the CEO. It was a surprise to us that decision was made, but actually we've met the CFO a number of times. He was the head of one of the divisions previously, so he's got sort of executive experience, and actually he's highly rated by us and by our analysts as well. So I think actually a solid pair of hands in order to continue to deliver that turnaround. But infamously, it takes a long time to turn these big consumer staple businesses round. It's not an easy thing to do, but I think there are early signs that actually the turnaround's happening, but it will be under a different management team. So that's Unilever. So Diageo, it has been a painful holding in the trust, and we have held on to it. We haven't been increasing the position over the last year or so. So I think what's happened there is there was clearly a boom in alcohol consumption during COVID, and that led to a strong sort of rise in shares. And what we've seen is that that's sort of been undone, where the company has lacked visibility in terms of where its inventory was. So not over the consumer had already bought their bottle of vodka and it was already in the cupboard, so it didn't need to buy another one. But actually through the value chain there was inventory which needed to come out of the system. So it has been painful. Growth has slowed, and with that we've seen the multiple come in there too. I think where we are now, the valuation of the business for what is a company which has got very strong brands and should be able to deliver growth through premiumization, so people drinking less but drinking better quality alcohol, it should mean that the business should be able to grow. But I would argue that given the multiple now, the valuation of the business, there isn't much in the price for growth. There we've got a new CFO that's come in from Coca-Cola, one of the bottlers, again highly regarded management team, so should be in a good place to be able to manage the business. Maybe we'll get a change in CEO, we'll see. But yeah, it's been a very challenging time for the company, but given where the shares have got to, it's very hard to make a case that you'd sell Diageo at this point, given the valuation.
Rebecca, can I ask a quick question? on the same sort of theme, can you talk about the portfolio turnover? And then secondly to that, when you do sell a business, what are the usual signs for you? What's your sell discipline like? When do you decide to sell?
Yeah, so as I say, it's a concentrated portfolio. So we've got 33 holdings. We're looking to invest on a 3 to 5 year time horizon. So it means that the turnover is quite low in the portfolio, and so we're taking, if we're taking the decision to exit, we'll be looking to introduce a new holding. So why would we look to exit a company? If I look at some of the exits that we've made in the last couple of months, so it can be a range of factors. So it could be that the investment case has played out. We've bought a business because we believe that it's undervalued and that it has the potential to deliver strong returns. And if we see that and we think there's less in the price now, then we'll look to exit. So an example in the portfolio that we've exited recently is Morgan Sindall. So they do fit outs for offices. They've seen very strong demand for that business. That part of the business. It's delivered earnings upgrades this year. The shares have re-rated. It's a really strong business, very well run, but we believe that the investment case has played out, so we're moving on. On the other side, it could be that if we've been wrong on the quality of the business, then we can take the decision to exit as well. So we had shares in Close Brothers in the portfolio over the last couple of years. That's been a very challenging business. The business has faced regulatory uncertainty related to motor financing, commissions, and so there's a level of redress for that business which has been an overhang on the shares. And the company cut its dividend. It was in a challenging place from a balance sheet perspective, and so we did take the decision to exit that. So there can be different reasons. Hopefully more the investment case is paid out rather than we've been wrong. But you have to admit that we are wrong sometimes. So.
Question here.
So just to pursue Close Brothers, do you not think that must have reached a bottom?
Yeah, I mean, the shares have been very volatile. They have bounced, so they got down closer to £2 and then now close to £4. So they have bounced when there's been a bit more clarity about what the outcome could be. So I do think that the view that we're sensing when we speak to industry experts is that it's probably not going to be the worst case scenario for the business, and so that should be positive for the shares. But you have seen shares recover a bit on the back of more sort of benign risk around the regulator, around commission redress.
Yeah.
Thank you for a very, very clear presentation. Everybody loves the dividend, and I've noted the 4.9%. Elsewhere, you said that you had a focus on total return, which I think most investors should probably take account of. I pulled some figures up for yourselves, and I'm slightly concerned to find that you'd underperformed the FTSE All-Share Index in 5 years, 3 years, 1 year, 6 months, and 3 months. The inference from that is that there might need to be a change in strategy to get a performance closer to, or hopefully ahead of the FTSE All-Share. And I wondered if you could comment on any thoughts your company has in that respect. Yeah. I should add, almost answering my own question partially, that would be influenced clearly by the discount, but actually from an investor's point of view, the discount is a factor, but it's the price that you can get that actually matters.
Yeah, okay, so in terms of the historic performance, it has been a disappointing period. The style that we talked about in terms of investing in quality businesses and also investing in that mid-cap part of the UK market has been a headwind to performance over the last 3 years. Most of the underperformance came in 2022 when we saw that very strong rotation out of growth businesses, highly valued businesses, and into value companies, and there was very strong growth in commodities sector and the banking sector. So that style has been a headwind. That market cap exposure has also been a headwind as well. But where we are now, so we've seen a very strong run in the UK market, actually. The UK market's up sort of 15% over the last year. It still remains cheap, but it's been driven by some of those cyclical businesses like banks. And where we are now, we look at these risks on the horizon. It's really challenging to think about, what is the impact on tariffs? What's the impact on, China? Are they going to stimulate or not? And I think what we still believe that we should be focusing on businesses which are strong and should be able to navigate that uncertainty. So, companies like, we've got Relics in the portfolio. This is a data and information business. Their value is in the content of their data, but also the analytic tools that they can give their customers. And that company, it doesn't depend on the macro. It's doing its own thing. It's seen its growth accelerate. It's growing its top line 7%. And that is a strong business that should be able to perform in a range of economic environments. So I think it's been an unhelpful period for performance in terms of some of those style headwinds. But given where we are now, we're feeling pretty good about where the portfolio is positioned and what the companies are doing, what they're saying to us, and how they're valued. We think the portfolio is in a good place to be able to deliver returns from here. And then you've got the discount on top of that. So that's the 11% discount on the value of the shares.
And we've got one final quick one, if that's okay, please. We've got 1 minute left. Thank you, Steve.
Thank you. I'm just wondering if you could tell us how much of the yield on the portfolio is natural yield and how much you're actually generating through the options overlay.
Yeah. So the underlying portfolio yield is just a small premium to the market. It's about 4.1% versus the market's sort of 3.8%. So there's a small premium, but it's not huge. Historically, the portfolio yield, underlying yield, has traded. It's been very similar to the benchmark. So we get additional income from option writing. That's about 10% of the annual revenues come from option writing. There's additional yields from gearing, and then the discount is clearly having an impact in terms of that 4.9%, which is the dividend on the share price. So those are sort of the three factors which create that difference between the underlying portfolio and the dividend yield on the shares.
Super. Rebecca, thank you very much indeed. Thank you for coming tonight.